Good morning, everyone. Welcome to our webinar. I think we're all ready to get started. Ross, you can see the screen?
I can see the screen. Thank you, Dean.
Excellent. Very good. Okay, so we'll get started. So welcome everyone that is watching live. And as always, these sessions are recorded to share with ourselves and our other clients that couldn't quite make it to this time slot today. But what we wanted to do is just give an update from an investment perspective of things that we're thinking about within the world and what your advisors are thinking about at Absolute Wealth Advisors. So welcome to everyone that's come along to join us today. Just a little bit of the introductions. For those that don't know me, my name's Dean Holmes. I'm one of the founders of Absolute Wealth Advisors. Absolute Wealth Advisors is about 17 years old in terms of when it first got started, and that was Paul Barrett and myself who started the firm. As you would all know, that we've got many advisors in the business now, and one of those is Ross, who's joining us today. Good morning, Ross.
Morning, Dean.
So Ross has been with Absolute Wealth Advisors for about 2.5 years. An advisor before that, and I've been working personally with Ross for a few years before that as well. So welcome, Ross. Ross is our financial advisor, and we play different roles, obviously, within Absolute Wealth Advisors, or different hats, as we like to say, from a business perspective. So Ross is here as one of the financial advisors at Absolute Wealth Advisors. He's also an owner of Absolute Wealth Advisors. What you'll find about our business is that every advisor that you actually talk to in the business is now a co-owner of the financial planning business, which we think is really important for our business succession and confidence that we can give you as clients over time as well. Ross, thank you for joining us today, and we will get started. So first and foremost, there is a disclaimer. You can't attend anything in a financial service context without a disclaimer. So a couple of things is that first and foremost, that I'm no longer a licensed financial advisor, so you're not getting any financial advice from me specifically. Ross here today is a licensed financial advisor. He's one of the 4 advisors within Absolute. This presentation is general in nature, so anything that Ross mentions that might talk about the financial advice process, essentially that's general advice. And if you'd like personal advice, you're all clients of Absolute Wealth Advisors, so all you need to do is reach out to your advisor to talk about anything you learnt today. They will know what's going on as well, and so you're welcome to spend some time with them as well in anything that we might mention or any concepts that come up today. But really what we're going through today is talking about what the financial planning process is in terms of coming to make an investment portfolio, what the decisions from a client perspective is in terms of what Ross is going to talk about, and then what the role of our investment philosophy here at Absolute Wealth Advisors, and also then how we implement that for clients. And so Ross, I'll hand over to you in a second in terms of talking us through some of the content on this slide. But this is the first step when we start to talk to our clients about investment portfolios. And so this will be a little bit old for some of you clients that have been through this a couple of times, but it's really important just for us to share the steps that we go through, and we constantly go through at Absolute Wealth Advisors, to make sure that the investment strategy that we've built for you last year is appropriate today, and making sure that we're still on top of everything that's going on within the market. So Ross, do you want to walk us through these sort of 5 steps in terms of the investment strategy, and just highlighting why that's important to make it individual from a client perspective?
Yeah, so as Dean said, that most of the people on the call would be clients, so we would have gone through a similar process with either myself or one of the other advisors in the firm. And that the main thing that I see before I jump into the steps is that when sometimes people come to us and we ask them, say, why have you got these existing investments in place? And there's sometimes not a clear answer. So that kind of talk to number 3, which is defining the investment objective. So we're a big believer that every investment should have a purpose. So it shouldn't just, while investing is great and we try and encourage all of our clients to be investing as much as possible, it's having a clear objective as to why we have that particular investment. What's the time frame? What are we looking for? So that talks to, I guess, number 2 as well. So we walk through the steps to say, understanding what our current financial position is today. So where are we today? And then understanding exactly what we're trying to achieve. And then that helps us define those objectives. So if we don't know what we're trying to achieve, then it's very difficult for us to be able to put in a strategic plan as we work around the circle. So it's working out exactly what are we trying to achieve? What's the time frame? What's the clear objectives that we're trying to invest for? So is it investing for retirement? Is it investing for a 5 or 7 year time frame for children's education or grandchildren's education funds? what that might be. And then obviously number 4 is educating you along the way so you can make an informed decision about the advice that we're providing. So while we as the advisors provide the advice and the recommendations and do a lot of the research behind the scenes, that at the end of the day, it's your money, it's your life. So we want to make sure our clients are adequately educated in the process so that they understand, maybe not at a deeper level that we do as advisors, but understand what we're trying to achieve, understanding why we've chosen the investments, and then obviously developing all those things together to have that strategic plan. So we know exactly where you are, where you want to be, what the objective is, and then we can obviously define and recommend that plan to help you get there.
Excellent. Thanks, Ross. And the bit that matches up with the investment strategy is the second part of that we've gone through with all of our clients over the years is what it's an industry term a little bit, Ross, in terms of what we call in terms of the risk profile. But a couple of the complexities that we're trying to do here is what's indicated on the screen, and we'll go through Ross's view as well. But we have to match two things. As Ross was saying, you're matching your individual goals, which therefore is your individual timeframes, to the right and acceptable level of risk that you would like to take on. But we have to contrast that with your goals in general. So the role of the advisor through this process is to let you know somewhat that you won't achieve your goals if you're not taking on enough risk, and then educate you around that journey. Or it might be the opposite, and it might be saying you no longer have to take on as much risk because you're already on track to achieve your goals. And Ross, talk to us about how risk profiles change over time based on goals, but also clients' age and stage.
Yeah, I think what you just said in terms of potentially taking less risk is an interesting one, is that we never want to be taking on risk if we don't need to. So we only ever want to take on an appropriate amount of risk to get to those goals. So to Dean's point is that if we get to a point financially that we no longer need to take as much risk and we can achieve all the goals by putting the money in a term deposit, then unless there's another circumstance as to why we would be investing or taking more risk, whether that's personal preference, then putting the money in a term deposit, while very boring and not that exciting, if that achieves the goal, then that's the amount of risk that we need to take. So we find this process part education process and then part helping us to define all those aspects to then build that appropriate portfolio. So we like to think of this as the sleep test. So how well do you sleep at night? So if we invested a large sum of money into the share market, are you thinking about this in the middle of the night, waking up, worrying about what the share market's doing? Are you reading the news on a daily basis? Are you checking your portfolio on a daily basis? And if you are, and it's causing stress, then it's likely you're not invested appropriately. So you're invested in something that you're not comfortable with, you're not sleeping at night, and you're checking the news on a daily basis, then there's a mismatch of where you're invested versus where you're comfortable with. So it is a bit of a balancing act, as we've got on the screen here. So the risk required, the risk tolerance. So how much risk are you willing to take, or are you comfortable with? And then what can we afford to take from a financial perspective? So understanding all those pieces of the puzzle, while the outcome might be different to where you want to be investing, it's making sure that we can stress test those things, that if the market does move up or down, that we're still invested in an appropriate manner, that you're not going to, as I said, wake up in the middle of the night and worry about what the market's doing.
Absolutely. And we'll get onto this in a moment, but the way in which we talk to this for some of the retired clients, Ross, is in that Farrelly's chart where we talk about the probability of clients running out of money. So we can never predict your date of death, to be really frank. And so that's a risk that we're managing, which we'll talk about in a moment. But that what we're trying to show you during those processes with your advisors is to minimize that risk that you're going to run out of money. We would love to spend our last dollar and our last day just thinking about how maths would work, but frankly, it's completely impossible. And so the risk tolerance definitely helps us to have that conversation with clients around what the right thing to do is.
So the next saying that, Dean, is that I'd like to say to clients is that if you do know the date you plan on leaving us, it would make our job a lot easier to plan for it. So if there's any insight that you can provide, that would make life a lot easier, but obviously we can't.
Plenty of dark humor here at Absolute Wealth Advisors, just to joke around. But definitely one of the things that we as a business have worked on over the years is being is obviously understanding investment markets and doing the work around understanding what's going on in the economy, economics, and then investment markets. And those two things can be aligned or can be mixed at different points in time. And then having an investment philosophy, because this is what we believe. And it's important that we believe it. So therefore, when we take it to our clients, they know and understand what our investment philosophy is. So this doesn't speak to any investment products, but if you were to reflect on what you currently have in your portfolio or what you may be transitioning to over time, is that this is the Absolute Wealth Advisors investment philosophy. And so Ross and I are going to go through each of the elements of this investment philosophy, because this is the driver of how we come to construct portfolios with you today, is that we created this investment philosophy, and then we then happily teach this to all of our clients and make sure that this forms part of everyone's portfolio over time. So Ross and I are going to go through one each. I'll start. Ross, it's easier if you just pick the one straight after, but you obviously don't have to. But this is our investment philosophy that we've built up over the years. So the first one that we want to talk through is that strategic asset allocation matters the most. And so as a definition, what strategic asset allocation really is, the percentage of money that you have in the large asset classes. So what you'll see in your portfolio is how much money you have in Australian shares, international shares, property, and that could be international, commercial, or investment properties, and defensive assets called cash and bonds. And so those big categories of investments, what we know over the history is that the percentages that you have in those asset classes gives you the best confidence of the future returns. So someone that has a high percentage exposure to different growth assets is going to have a higher return over time than someone with less. But the right allocations of these in growth portfolios or high growth portfolios actually results in the highest likelihood of the correct returns in the portfolio. And what I mean by correct returns is the right return for the level of risk that we're taking on within any of those portfolios. And so when we think about getting exposure to those markets, we'll jump onto that one as we go down the list. But the first step is trying to work out, as Ross said, your goals, therefore the risk profile to achieve those goals, and therefore what is the right strategic asset allocation to achieve those goals over time. So typically speaking, and it's really generic, but you'd say that someone that's younger may have a larger exposure to growth assets because they've got a lot of time to grow that portfolio. Conversely, someone that has less time or is more closer or in retirement may have a different strategic asset allocation, the balance between growth and defensive. Ross, you can pick your next one.
So I was going to take diversification because that was the next on the list. But I think the overarching one that jumps out for me when we look at our clients' portfolios is to keep it simple. So I think that is a core belief in terms of our investment philosophy, is that we are not, as the description says there, that we're not trying to chase the next trend or the next hot investment. So I'd like to explain to just my clients is that I'm not calling you up in the middle of the night to say we're buying this share or we're selling this share. We're not day traders in that sense. We keep it simple. If we can simplify a portfolio appropriately, then we would prefer to do that rather than a complex portfolio with lots of different investment options and maybe things that aren't well tested over a long period of time. So as I said, at the core of all this is that if we can take a simplified approach without impacting returns, of course, then that would be our preference to do.
Yep. Excellent. So the two that I'll talk about that's relevant as we go through this exercise is the concept of diversification matters. And so this links really well with the strategic asset allocation. Is we still believe that diversification matters. And so what that means to us is that having an exposure to both Australian shares and international shares is an element of diversification. Both of those asset classes might move in a similar way, i.e., when you wake up in the morning and the US stock market fell overnight, it's highly likely that the Australian market falls a little bit as well. So there's that they move in a similar way. But what the diversification really means to us is that in the US, you can get exposure to technology companies that you can't get in Australia. in Europe, you get exposure to medical companies that you can't get in Australia. Diversification is a geographical diversification, but also then it becomes an industry-based diversification as well. And so those things matter. When we look at long-term returns, we see different returns across different countries and different industries. And so we want to make sure that we get a broad exposure to those asset classes. The tactical asset allocation is where we where we theoretically could make decisions to go underweight a particular asset class. And what we're saying in our investment philosophy is we would only ever do that in extreme cases. So there might be an extreme case when we think that the investment committee might say a particular asset class is significantly overvalued and we'd like to therefore own less of that asset class, but it's only at the extremes. And the reason why it's only at the extremes is that at the end of the day, it's very difficult to pick the top of any market. And also it's frankly, therefore, impossible to pick the bottom of any market. And so these extremes are extreme for a reason. They're very hard to predict and they're very hard to pick. And so most of the time we won't do anything with the tactical asset allocation at the investment committee because we know how difficult it is to time the market. Ross?
Yeah, next one I had was the active versus passive management. And I was using this analogy last week talking to a client about this in the context of the NRL. And I'm not sure what the same analogy for the AFL is, but what I explained here was that in line with the keep it simple is there's the Melbourne Storm, obviously in the NRL team, that has some crazy stat around how many grand finals that they've played in the past 15, 20 years.
I think it's 9 out of 20.
It's not 9 out of 20.
Or 11. No, it might be 11 out of 20, if anyone knows any better than that.
They've consistently been one of the top performers. Now, they haven't necessarily won the grand final every single year, but they've been in one of the top performers. So their methodology, if you know anything about NRL, is that they are very simple and sometimes can be considered a little bit boring to watch because they take a methodical, simple approach to how they play. So the reason I use that analogy is the active versus the passive management, in the sense that our preference, as it says there, is that we tend to look for passive investments because those have had historically outperformed the active approach. Now, they are sometimes called a little bit boring or a little bit simple when we think of it from a passive perspective, but we take that approach that if we can consistently be in one of the top performers, then that would be our preference. Now, we don't discount active management altogether. As we've said there, is that we do look for active managers if they can show a clear record of outperformance. So if they have consistently outperformed from an active perspective, we'll still consider that. But our preference, due to research and historical data, is that a passive approach generally outperforms an active management more times than not. And the other one I'll mention there is that there's the Warren Buffett bet, that Warren Buffett took a 10-year bet with the top hedge funds in America to say that he would invest in the S&P 500 or their version of the index fund. And if any active hedge fund manager could outperform him, then he would donate. Correct me, Dean, I'm not sure.
I think it was $1 million bet overall.
Yeah, $1 million to charity. So he took a 10-year view and he won that bet. I think that ended a couple of years ago. So as I said, that aligns with our keep it simple approach. So as I said, preference is passive management if possible, and then active management if it shows a clear record of our performance.
Yep. Thanks, Ross. Next one to just pick up a couple as well to talk through is one of the ones that we believe in is liquidity matters. Now, liquidity is a technical term on our side of the coin, but essentially what that means is the ability to get your money back within a reasonable time frame. So I can contrast the two. When you sell a share on the Australian stock market, you get your cash in 2 days, regardless. When you go and intend to sell a commercial property or a residential property, you make the decision at least 6 weeks before auction day, and then you wait 6 weeks after auction day in order to get your money. And so that's the two ranges of liquidity. There's some extremes in some types of investments where the fund itself may get locked up and the ability for you to get money back is restricted. And what we see in history is the times in which you need the money is actually the time in which there's stress in the markets, and therefore your ability to get your money back when you want it can be impacted. And so liquidity is really important for us when we're thinking about constructing portfolios for clients. Not that we want to transact, but the ability to transact gives us a level of a cushion or a level of safety that if we need to do things, we can do it and return money or rebalance money much easier. So liquidity is really important for us. And the one that somewhat balances in with that is this concept of volatility. And so volatility is the movements in the stock market overall. The stock market will go up and go down on any one particular day at different points in time, i.e. when Trump indicated that he was going to do some very large tariffs, there was a large amount of volatility, i.e. the stock market fell, just like with COVID and September 11 and all these events in the past that have resulted in the stock market moving down and then up. That volatility shouldn't concern us if we've done all of our homework. And so that's when I look at Ross and say volatility shouldn't concern the client if he's done the right risk profile, if he's understood their investment needs and why they're investing that money. When we get up to my role in the investment committee, then when money's invested, we're comfortable because clients are not going to turn around and need that money at the worst possible time. Ross's role is to coach you through that volatility at any point in time. And when markets are volatile, Ross and all the advisors want to talk you through what's happening, but it's to talk you through the process and re-educate as opposed to needing to sell at any point in time. And so volatility is part of investing in the market, and markets have been becoming more volatile over time because trading can be much faster now than what it was in the past. However, it's part of being a participant in the equity markets overall, it's just part of the game. Ross, you can do the last one or two.
Yeah, so the bottom left-hand corner there says that timing the market beats trying to time the market. So this again goes back to our philosophy of being predominantly passive investment, preferring passive management and keeping it simple. So that I mentioned before, we're not calling clients in the middle of the night to say the US stock market's just opened, we should be buying this or selling this, and because X, Y, Z's happened. Now, if we think there's a shift happening, then we will look to make those shifts over time. But we're not trying to play the Wall Street stockbroker and trying to time those individual market movements on a share level. So we believe, and history has shown us, that if we invest long enough, then tends to go upwards or trending upwards. Now, that doesn't say that it's always going to go upwards. That doesn't discount the volatility. To Dean's point, is that over the short term, we know that the share market's going to go up and down. But generally speaking, over a long-term time frame, history has shown us that the share market will trend upwards over that long enough time frame. So rather than trying to time to say this is the best time to get in or this is the best time to get out, if we're consistently investing over the long term, then we're generally going to see an upwards trend and an upward return from that perspective. And then the final piece there is the cost matter. So we believe, again, going back to the keep it simple and the passive management approach, is that if we can achieve a lower cost investment, then we know that it has a high correlation between higher returns because we're investing at a lower cost. So that's not impacting our returns as much versus the complete opposite of investing in higher fee investments. It makes it harder for that investment to outperform because it has to beat the fees that it's paid to obviously get there. Now, if we can achieve a lower cost investment management without impacting returns, then that alongside the keep it simple and the passive management approach would be our preference where possible.
Excellent. Thanks, Ross. That is the Absolute Wealth Advisors investment philosophy. So you're welcome to ask us questions at the end about any one of those elements if you'd like to do. But this is something that we've built and believed in for many years. For some of the longer clients that are on the call, they've got exposure to everything that we believe in on the screen here today. And whilst we're still always doing research on what might be the future, our investment philosophy has been quite stagnant for a fair few years now in the process. So moving along in terms of what the next thing that we wanted to let everyone know is, as the business of Absolute Wealth Advisors has changed and grown up over the time. And so Paul and I were just Paul and I in the beginning, and then it was Paul, Dean and Stella back in the day. And now we're actually, Absolute Wealth Advisors is a much bigger team, approaching 20 people within the business now. And so one of the evolutions of that is that we've looking to improve and strengthen our investment team as well. And so we now have what we have in terms of an investment committee within our business to help get some external and internal input into what's driving investment decisions for all of the clients of Absolute Wealth Advisors. And so we wanted just to highlight this, just so you understand that there is some support in the background, and we're not in this situation where an individual advisor is choosing your portfolio or recommending a portfolio without the consideration within the background from a business perspective. And so we formed the investment committee, and that investment committee is Paul Barrett and myself as representatives from Absolute Wealth Advisors. And then we've got a third party company that their business name is called Evidentia. They recently were acquired by another company that's listed on the stock market. It's now ASX top 100 company. And so Evidentia is an asset consultant. And so what they do is they help financial advisors with research, opinions, to help build great investment portfolios for clients over time. And so we've partnered with Evidentia to help create this investment committee, which then you'll see at your individual advisor level. They're able to talk to you about the portfolios and the changes that might be relevant for you. But it's really important to know there's a team behind you. And so no changes is recommended without the research team and the approvals of the investment committee in terms of things that we do. And so the role of the financial advisor is still really important, because the financial advisor is the person that knows you. They know your objectives, they know your attitude to risk, they know what you're trying to achieve. And so what the investment committee is trying to do is create that two roles within the business, that Ross is here understanding your complete situation and needs. And then what I'm doing at the investment committee level is understanding what's going on in the market, understanding how we're constructing portfolios with Evidentia. And then the sum of the two is that Ross is then working with you with a lot of support in the background.
And I think just from that perspective, Dean, from an individual advisor level, is that it gives me, Stella, Anthony, and Louise in the business a lot more as robust support. So rather than me doing and having to do all the research, and while I think I'm very good at my job, that I know there's things that I don't know. So having the investment committee to sit there behind me to say, hey, this is what we see at a much higher level from looking at things from a different angle, that gives me more confidence that we can obviously be doing the right thing by our clients and putting our clients in the best position, because it's not only my brain trying to figure out these problems, it's obviously yourself and Paul, and then the backing of the Evidentia group as well gives us, again, a lot more confidence in terms of what we're doing for each of our clients.
Yep, exactly. And so the next thing we wanted to just talk about in terms of, as I've recently been doing a few cybersecurity related updates for clients of Absolute Wealth Advisors as well. And so, Ross, can you talk us through the chart here? What we wanted to let clients know is elements of how we and the investment community overall, how we manage client money and who is there to provide checks and balances in the process.
Yeah, so what we've got at the top there is the relationship between me in this example as the financial advisor and the client. So we're working at that level to everything we've just gone through in terms of understanding your goals, your objectives, where you are now, what we're trying to get to, what your comfort level is with risk, how much risk do we need to be taking. So we're working through all those things at that level. Then we look to, generally speaking, for most of our clients, we use a wrap platform. So a wrap platform is essentially an administrative platform that sits there to help us with all the reporting, the investment management, tax reporting, everything that we need to help obviously manage your money on an ongoing basis. Now, the complete opposite to a wrap platform would be manage your shares directly through CommSec, NabTrade, Westpac, something like that, where you're looking after it, not via the wrap platform. So the wrap platform gives us that functionality from an admin perspective. underneath that wrap platform, and this is something that we continue to educate clients, is that the money isn't invested in, so there's a number of different wrap platform providers, but Hub24, CFS Edge, NetWealth, Australian Super is not necessarily a wrap platform, but essentially a platform itself, is that your money is not invested there. It's invested in the underlying investment holdings. So what we can see on the chart there is that underneath the wrap platform, there's a series of different investment options. So using the Australian Super example, is that you're not invested, or your super isn't held with Australian Super, it's invested in underlying investment holdings. So if you had a wrap platform of CFS Edge or Hub24, for instance, there's lots of different ones out there, is that your money's not invested there, it's invested in underlying holdings. So what could potentially be under that wrap platform is your cash or your cash account, a series of one or multiple managed funds, shares and exchange traded funds could sit under there, or like we've said on the screen, we've got a managed account portfolio. So there's lots of different investment options that can sit underneath that wrap platform. But that is an administrative platform, and then there's the underlying investment holdings.
Excellent. Thanks, Ross. And the key here is that there are a few, when we think about cybersecurity and protecting clients' money, there's a few roadblocks or custodians. So there's this concept that there's responsible entities and custodians that are hopefully putting brick walls in terms of this process for protecting your wealth from that perspective as well. And so it's really important to know that we're aware of Absolute Wealth Advisors has the ability to transact on your account and transfer money on your account, potentially back to linked accounts, but we're making sure that we're authorizing that back through you as well as the individual client. So we know that you're requesting and making those transfers or those requests for transfers. So this is how often financial advisors manage capital for clients, and it gives the financial advisor the elements of control, gives the clients the element of reporting and information that's important to them, but also has that custody protection at the same day in order to make sure that clients' funds are kept separate but also safe in that process.
Yeah, I think the final point there is that the money invested for clients, and hopefully all clients on the call would understand this by now, is that the money isn't invested with us. It doesn't get deposited into a bank account that we own. It's always in, obviously, your names as the client level. So the wrap platform, the investment account is always held in the client's name, which hopefully that should be well understood. But there may be things on the news, or especially in America, where money gets put with a financial planner directly, which is completely opposite of what we do here. So there's always a clear separation between, we're providing advice, you're not investing money with Absolute Wealth Advisors and we're not holding the money in our own accounts. It's always in your names.
Yep, indeed. Thanks, Ross. So the last thing that we wanted to just highlight today in terms of some of the things that Ross thinks about from a client perspective, and this is for all clients, but we're showing the journey into retirement. And so the interesting considerations here is how employment, working life, moves into what we call active retirement, and clients will determine their own length of active retirement, or their body will choose it for them at some stage as well. But the active retirement, and then the final phase is a little bit more of a passive retirement. And so the journey of Ross, or journey of the financial advisor, is to take our clients through this process over time. And Ross, what changes as we go through this particular chart?
So going back to those original things we mentioned as to what the objective is. So each investment needs to have a clear objective. So the objective for a 20-year-old or 30-year-old that we might be investing for the next 30 years, and they're starting their journey, versus someone that may be entering in their retirement at age 60 or 70, those objectives are very different, because the main thing there is that for the younger client that have the longer time frame, they have active employment and they have active income coming from their employment. So their reliance on the investment income that they need is very minimal. Comparing that to moving into a retirement phase where employment income or active income from employment has either ceased completely or is reducing pretty rapidly, then that reliance on the investment income becomes very important. So the need for liquidity, the concept of understanding how much we need each year, how much are we willing to invest in versus leaving in different buckets, which we'll get to in a second, becomes a lot more important compared to, again, going back to that 30-year-old that they don't need to touch their investment. They don't need investment income for the next 10, 20, 30 years. That's the key difference in this example.
Absolutely. And so those buckets you mentioned, Ross, this is a picture of how the advisor might think and talk to you about in terms of keeping capital in different buckets. It may not practically be separated into these three, but Ross, talk us through the concepts of these three when you're thinking about a retirement portfolio.
Yeah, so going back to that key principle of liquidity, so that is the short-term portfolio need. So how much money do you need access to in a short space of time, so 1 to 3 years? How much income do you need on a yearly basis? We work out to say, okay, if you need $100,000 a year to cover your living expenses and travel, for instance, we want to make sure that we can have access to 1 to 3 years worth of capital at a very short space of time. So whether that's leaving money directly in a cash account or a high interest savings account, potentially putting that money on a term deposit or in short-term income funds, something that we can get very easy access to that hopefully has and ideally has very low liquidity. So we want to make sure that
low volatility.
High liquidity, low volatility. So we want to make sure that if you give us a call and say, I need an extra $20,000 to take that trip to Paris, we can easily get you that money. We're not worried about what the share market's doing on that day because we're taking that out of the short-term portfolio or the cash portfolio. So then we move on to the medium term. So that is to say, we know that we'll need access to some money in the future. It's not quite the 1 to 3 year time frame, but we're going to need access to some money at some point in time. So we want to make sure that, again, worrying about the volatility of the share market is that's not impacting our decision to be able to get access to those funds. So we want to make sure that the combined two buckets of the short to medium term portfolio gives us that comfort that if the share market decided to go down in the future, we can still meet your living expenses, we can still meet those potential medium-term capital needs without touching the long-term portfolio, which is bucket number 3. So again, this comes down to what the objectives are, this comes down to what your liquidity needs are, and comes down to the time frame involved. So here's the example of a 30-year-old investing. They're probably not going to need any short-term portfolio needs. There's probably no medium-term. We would probably put it, in this superannuation example, put their money into a long-term portfolio and they don't really need to touch it. Versus a retirement portfolio, there's going to be more need for that short to medium term. And then we can work out what's an appropriate amount to put into the long-term portfolio that's going to give us, as it says on the screen, that capital growth that's going to provide us some income distributions, etc., to fund those short and medium term needs.
Absolutely. Thanks, Ross. And the reason why, from a advice perspective and also the investment committee perspective, there's 3 risks, which is the final thing we think about when it comes to managing clients' wealth well into their retirement and later years. If we've got 3 things that we need to be cautious of through this process, is the first one is longevity. So that is people living longer than what the Australian Bureau of Statistics would tell them they're allowed to live. And so that's actually increasing. You would probably know a friend that's lived longer than what you thought they may have lived. And so definitely we've got a risk that we need to be aware of, that portfolios have to last longer in retirement than what they did 10, 20 and 30 years ago. Second risk that we're dealing with over time, or measuring and monitoring, is this concept called sequencing risk. As a very simple example, this was retiring on a Monday and on a Tuesday, the stock market falling 20%. So there's a risk that if the stock market falls a day after you retire, it could have an impact on your retirement income for the remainder of your life. And so managing that in the years leading up to your retirement is actually really important on how we're taking the foot off the accelerator, for an analogy, of the growth assets to reduce the risk that sequencing risk can have a big impact on your portfolio. And finally, something that we've all experienced over the last 3 years, as well as the last 30 years, is this concept of inflation. So there is a real risk that we need to be aware of and managing to inflation over time as well. And that's where the impact of term deposits, while safe, doesn't provide you an inflation-adjusted income, whereas on the other side of those buckets, as Ross was indicating, there is a growth in dividends and income that comes from investing in growth assets, and that provides that inflation hedge or reducing that inflation risk over time. And so there are three things in this concept when Ross is talking to an individual client about retirement. In the background from the work that we're doing on the investment committee, we're trying to be aware of these three risks and then manage those with clients as well. So that's all for today in terms of what Ross and I would love to share. So we're happy to take questions. Both you can come off mute if you can do that and yell it out. That's absolutely fine. You're more than welcome to put it in the chat as well. The other thing that we'd really appreciate is if you have any topics or areas that you thought we were going to cover today that we didn't, or any other ideas of content that you'd like to hear from us, please let us know either in the email that comes out or in the chat is perfectly fine. As you may know, or you will know when I go to the next slide, the next event we're having is another cybersecurity event. So I'm running these quarterly for all clients to make sure that we're aware of what's going on from a cybersecurity AI perspective in terms of keeping our assets safe and making sure that we're on top of that. So that's the next event. We'll be sending an email around that for November. But yeah, as I said, if there's any questions, happy to hear them. Otherwise, we can call it a day today. So I'll just give a couple of seconds of silence. The other comments in the chats were just thank you. We'll call it a day there as well. Look forward to seeing you on the next event. And if there is anything else you'd like us to talk about, please reach out to Ross and myself. We'll make sure we cover it in some of the other events that we're planning for 2026. But until then, have a great day. Thanks, Ross, for being here. Thanks everyone. Have a great day.